lot of founders will look at a P&L and see that they have a net profit of $50,000, get all excited, log into their bank account, and they don't have $50,000. And they're like, but where's the money? So what you need to understand is your P&L is telling a story. It's not telling you what you actually have in the bank. Hello and welcome to today's episode of Pivot to Profit. I'm your host, Pam Jordan, and today we're going to be doing an accounting 101. And you might ask why? Well, y'all, I talk to founders all the time, and it's amazing how good they are at what they do. Building their product, building their business, selling their services. But there's this thing called numbers and accounting that unless you went to school or you've had training, you just might not know. Even this week, I was doing a training with 23 seven-figure founders, and I was talking about cash flow and profitability. And in the chat of the virtual training, people were asking questions like, what does cash flow mean? What is AR? What is AP? And I realized really quickly that it's time for me just to do a basic accounting 101. So strap in, guys. I am not going to be boring. We are going to be using everyday terms to explain these things so you as a founder, business owner, CEO can truly understand what these terms mean and what's important. Because I've helped multiple 6- and 7-figure founders understand their finances so they can increase their profitability and bring freedom to their life, freedom of both time and money. And look, there is no shame. I am not good at lots of parts of business, technology, marketing. Why? Because I was never trained on those things. And so I have people on my team or contractors that I use to step in and help me in those areas. So there is no shame as a founder, CEO, when you don't know your finances. But as you're scaling, it is time to start understanding those numbers. Because if you can understand the basics, you can start to have intelligent conversations with your banks, with your lenders, with investors. Because here's the thing, your numbers tell a story. And if you're not understanding what that story is, you're gonna sit across the table from a bank, from an investor, from a potential buyer. And if they understand the numbers better than you are, unfortunately, they're gonna win and you're gonna get less money than you want for your business. So here's the thing. There's 3 ways of looking at your businesses financially. The first one that we're going to be talking about is profit, and that's your P&L, your profit and loss, or your income statement. This talks about, are you making money? Then we're going to talk about the position of your business, the balance sheet. What do you actually own versus what you owe? And I'm going to break all this down for you in basic terms. And timing, and that's where cash flow comes in. When does money move? And so it's important to understand these basic terms. So let's start with a P&L, a profit and loss, an income statement. This is your profit story. This is essentially your company's report card. And the thing about a P&L is it can be a snapshot like a Polaroid, or it can be a video. It can be months, years, comparing years to years. So the thing about a P&L is it can range in time. So it can show changes, it can show seasonality, the ups and downs. And the basic formula for a profit and loss is income minus cost of goods sold minus expenses equals profit. Now that's not the formula that we talk about when we talk about cash flow and cash management with profit first, but the formula for a profit and loss is income minus cost of goods sold minus expenses equals net profit. And the thing to understand is profit doesn't mean money in your bank. So a lot of founders will look at a P&L and see that they have a net profit of $50,000, get all excited, log into their bank account, and they don't have $50,000. And they're like, but where's the money? And they'll look and say, oh, look, I made $1 million in the last 12 months. And they go to their bank, where's the money? So what you need to understand is your P&L is telling a story. It's not telling you what you actually have in the bank. So it's showing the money that you collected, the money that came out of the business, and what was left. And unfortunately, there's things that come out of your profit, the net operating income at the bottom of your P&L that makes it so that's not what's in the bank. The biggest one to consider is if you have any debt, long-term loans or short-term loans, the principal portion of those payments comes out of your net operating income. Also, if you're taking distributions, that comes out of your net operating income. So you need to be aware that your P&L is telling the story of money coming in and out of your business, but it is not saying what is actually in your bank account. And the important thing here to understand is the net operating income or the net profit on your P&L is what the IRS looks at for taxes. So while that money is not sitting in your bank account waiting for you, that is what at the end of the year, the IRS is going to have say that that's what they're going to tax you on. So it's really important to understand what information you can gain from a P&L. And the answer is a lot. A P&L is a very powerful tool because as fractional CFOs, we can tell you where you're making money and where you're not. Specifically, if you have multiple products or services, this is a great tool for us to be able to say, this one's making money, this one's not so great, and this one's tanking, and help advise you on how to either improve the ones that are not profitable or raise prices or shut down those product lines or services if you're not making money. But you need to understand that just because your P&L says you're profitable, that doesn't mean that you have money in the bank, and it doesn't mean that you're winning at this game. So it's important to look at your P&L at least on a monthly basis and be able to make decisions from it. But the other thing to understand is your P&L is just looking in the rearview mirror. It's telling you what's happened. It is not telling you what's about to happen. So it's important to have both views. A P&L is important. Look, if you ever want outside money, if you ever want to exit your business, they're going to sit down and smile and listen to you talk about your business. And the first thing they're going to ask for are the numbers. They're not going to ask for, well, tell me about your product. They're not going to say, oh, how amazing is your team? They're going to say, show me your numbers. And your P&L is one of those reports that they're going to want to be able to judge, is this a sustainable business? Are you playing this game well? So it's imperative to make sure that you have a really strong P&L, that you know what it says, and that it's accurate. And the thing is, there's lots that can go wrong with bookkeeping. So make sure you have a strong bookkeeper. Make sure that by the 15th of each month, you have last month's report. And if you don't, it's time to call your bookkeeper and say, hey, where are my numbers at? All right, so that's a P&L, profit and loss income statement. All of those terms mean the same report. Super important. Make sure you get it on a monthly basis and that you're looking at it. The next report that we're going to talk about is a balance sheet. And unfortunately, a lot of entrepreneurs just ignore this report because it's confusing. And as far as time frame, a balance sheet is a Polaroid. It is a snapshot of your business at a certain point in time. It's not over time. It is as it stands at that date where we are. And the formula for the balance sheet is assets equals liabilities and equity. So it's a teeter-totter. So your assets are going to equal the other two. Assets, this is cash. This is receivables. This is money owed to you. This is money that you have in the bank. Liabilities, this is debt. This is money that you owe other people. This is your credit card balances. This is your loan balance. And equity is what's left. And that's how you as the owner know the value of the business. Your P&L might look great, but your balance sheet could show a completely different story. I've met with 7-figure business owners who come to me, show me their P&L. I'm like, all right, looks like we're doing pretty good. And then I go to the balance sheet and I'm like, oh no, we have a huge problem. You are drowning in debt. You have all these assets, which is beautiful because you have all this equipment or inventory or whatever your assets are, but then you owe a lot of people money. You owe a lot of debt. And unfortunately, that means that your debt to equity ratio, which is another number that outside investors look at and banks look at, is going to be off. Because if you owe a lot of people money and you don't have a lot of money, you're imbalanced. And so outside investors and bankers aren't going to want to give you that other equipment loan or extend your line of credit because you're overly leveraged. Imagine your business is running and operating, but you have $500,000 worth of debt and you're only making $10,000 a month. The math doesn't math to be able to carry that debt. And so bankers and investors and people that you potentially will exit to aren't gonna like that. So it's important to look at your balance sheet, understand it's a snapshot in time, understand that the money that's owed to you, the assets that you have, needs to be equal to the liabilities and equity, but you can't have too much debt because people aren't gonna wanna renew your line of credit. So it's important that you look at both of these reports, understand what they're saying about your business, because this is also, again, outside people are going to look at this. And I recently have a client that is purchasing a large commercial property and their P&L looks really strong, but their balance sheet isn't as strong because they have some debt. And so we're having to juggle conversations with the bank to help them understand the financial position of the business so that we can get that loan. And it's because of some debt that they took on early on in their business. So understand that those short-term loans and those long-term loans that you have to get you out of a sticky situation can be helpful and necessary to continue on with your business, but they sit on your balance sheet and they don't make you look great. So it's important to understand your cash flow so that you can pay down your debt as quickly as possible without draining cash from the business. So we've talked P&L, we've talked balance sheets. Hopefully this makes sense. It's a simple formula for both of them, and it's just important to look at them at least on a monthly basis to see where you are. And it's a really good tool. I myself, as the CEO of my business, look at my P&L every month. And I was looking at Q1 of 26 compared to Q1 of 25, and something wasn't adding up. And so I had one column of 25, one column of 26, and a column that showed me the difference. And I was like, something's not mathing. And I went in and I figured it out, and I went to my bookkeeper and she's like, oh yes, you're right, that's going to the wrong account. Fixed it, and all of a sudden, my reports looked a whole lot better. But it's because I understood my P&L and I was comparing it to a prior period where I could see something doesn't smell right. Something's not matching. We did an adjustment to a couple expense items, moved them to the right category, and voila, the P&L was accurate and much better, made us look, one, it was right, and two, it put us in a much better light if anyone were to come and see it. So now let's talk about money that you owe people and money that is owed to you. So the first one is accounts receivable, or AR. This is money that is owed to you. This is if you invoice clients and they don't pay you right away. This is revenue that hasn't been collected yet. And this is a huge factor in companies' profitability, because if you invoice clients and they wait 10, 30, 60, 120 days to pay you, that means that you are performing services and fulfilling services without collecting that money. And it is so important that you track your AR. We had a client come to us, she's a service-based business, and she did not have checks and balances in her company. And unfortunately, the person that was in charge of her accounts receivable, her AR, was not on top of it. And she actually lost over $100,000 because they weren't following up with clients, and the window of time for them to be able to collect on that money had passed. And so over $100,000 of cash that was owed to her that she fulfilled on, she could not collect. And if you're in the construction industries or the trades, accounts receivable is huge. Because if you're performing services and not collecting money on that day, then you have clients that owe you money. Especially if you do commercial work, this can be very expensive because you're essentially banking your clients and waiting for them to pay you. So accounts receivable is very important to keep track of on a weekly basis. Who owes you money? Who do you need to send emails to? Who do you need to remind? Who do you need to send a late notice to? Making sure that that money gets into your bank account. Very, very important. And for context, accounts receivable shows up on the balance sheet in the asset portion because that is money that is owed to you. Very, very important. If accounts receivable is a big factor for your business, I suggest you track this on a weekly basis and you have someone in your business that is bird dogging this money and making sure that it's collected. I had a HVAC company. Our CFO team walked in. They had hundreds of $1,000s in AR. And so we had to create systems and SOPs, and we were able to collect all of that money and be able to have the founder take a very deep breath because that was a lot of money that he was able to collect, get into his business. And now his team is following those systems. And on a weekly basis, this is what they do the first on Monday. This is what they do on Wednesday. This is what they do on Friday to make sure that money keeps coming in. So let's talk about accounts payable. This is also called AP. And this is money that you owe others. So this is if you have vendors or subcontractors that send you a bill and you then have to pay it. So this isn't the software that already charges your credit card. This is vendors and service providers that send you an invoice and you have to process the payment. So whether that's you use a bill pay, you use Bill, you use Melio, there's lots of softwares out there, but this is money that you owe other people. So here's the challenge with accounts payable is if you're looking at your P&L and you haven't paid those bills yet, you could think you're a lot more profitable than you are, but because you haven't paid those bills, once you pay those bills, your net profit's going to go down. So you can be profitable on paper, but then you have AR that needs to be paid. You're not as profitable as you think. And AP, accounts payable, money that you owe other people, is in the liabilities portion of the balance sheet. And so that's why it's important to look at both your P&L and your balance sheet to see the whole picture of your business. Because if you have money that's owed to you, bills that you owe that aren't on your P&L, you can think you're in a much better position than you actually are. So it's important to look at both documents to understand the full picture of your business's finances, because that shows you what you owe other people and what money is actually moved. So when I explained accounts payable, I brought up cash basis. So when you look at financial reports, your P&L and your balance sheet, there's two lenses that you can use to look at them. The first is a cash basis and the second is accrual. Both are important, and it is critical to understand the difference and how you're looking at them. So if you get reports on a monthly basis from your bookkeeper, which you should, it's important to note if you're getting them on a cash or an accrual basis. And both are important and both are useful. Depending on the type of business you have, you just need to use and focus on one. So cash is the most common. And this is where if you look at your reports on a cash basis, you only see numbers on your P&L and your balance sheet if money moves. So this is just tracking, I pay a bill, I've collected money. So your P&L is only gonna show what money is actually moved. So it's not gonna show your accounts receivable. So it's not gonna show the invoices that you haven't collected, and it's not gonna show your accounts payable, the vendor bills that you haven't yet paid. Cash is most of the time the easiest and the best to use for most service and products, unless you are fulfilling on your service or products over a long period of time. So if that's the case, then typically accrual basis is the best answer. And that's where if you have a 12-month program and you collect all the money up front, accrual makes the most sense because you can split the $12,000 that you collected in February out $1,000 a month for the next 12 months. Accrual basis shows the revenue when it was earned, not when it was collected, and shows expenses when they were incurred, not when the money leaves your bank account. So again, this is really helpful if you have services that you have to fill on over a long period of time and money is collected at different points in time. So we do this with coaches that have subscription programs and coaching that takes multiple months to fulfill on. We also do this with our construction clients because they are working on a property for 6 to 18 months and their payments come in sporadically because they have a significant accounts receivable, right? Like some of our clients wait 90 days to get their cash. So using cash reports is going to make them look really, really bad for a few months and then really good 1 month because the money comes in and then really, really bad. So we use accrual accounting, an accrual basis for their financials to recognize the revenue piece by piece each month based on what they performed and the expenses based on what they actually had each month. So for most of businesses, cash basis is the easiest, most straightforward, and the best answer. But make sure when you're looking at a P&L and a balance sheet, you understand which one you're using. Because accrual is great for decision making if you have long-term fulfillment. But cash is much easier to understand. And it's also important to understand how you're looking at your reports now, but also how you report your taxes. Because if you're running your business on an accrual basis all year long, and then when it's tax time, you file on a cash basis, you need to understand the implications of that and vice versa. So if you're scaling, you should at least know what basis you're looking at and what tax basis you use. The final thing when it comes to numbers is to ensure that everything is being reconciled at the end of the month. So this is the old adage of grandma or grandpa reconciling their check account. This is where grandma would write down the checks, and once it hit the bank, she would make a check mark. It's the same thing. We typically use QuickBooks Online with our clients. It's our preferred software, and there are more advanced version if you need it. But QuickBooks Online is a great software for most clients to be able to use it. But this is where we say this is what QuickBooks says, and we match it to the bank, and it's check, check. It's an actual act that needs to be done by your bookkeeper at the following each month that says, here's what the bank statement says, here's what QuickBooks says, everything matches for dollar, and check it all off. This prevents fraud. This prevents duplication of expenses. This prevents manual entries that throw your reports off. When we have clients come in, we do an analysis and we do a validity score. So we actually rate your books. And you guys, we have done hundreds of these validity scores, and only once have we gotten 100, and that was in like the last 2 weeks. So most of our clients come in and their books aren't accurate, and one of the key things that we see is the monthly reconciliation is not done. If your books are not reconciled at the end of the month, there's a distinct chance that the numbers that you're looking at are wrong, because we're not matching what happens in QuickBooks to make sure it matches the bank statement. So it's super important that your bookkeeper is reconciling. So if you're paying a bookkeeper and they're not reconciling, you need to get a new bookkeeper. That is not accurate bookkeeping. I understand this is a lot of information, but as a business owner, a CEO, it is your numbers. So it's imperative that you understand what these reports are telling you. And if it's too much, then look, my company's Pivot Business Group, we do the bookkeeping, we do the fractional CFO, we'll do the analysis and help you understand. We create dashboards where it's like charts and graphs where you're like, am I good or am I bad? We'll give you just a handful of key numbers to track on a weekly and monthly basis to know how your business is doing. So if all of this has been like amazing, I got it, run with it, go, handle it. But if it's been too much and feels heavy and overwhelming, just go to pamjordan.com. My team would love to help you understand these financials, because remember, it's not what you make that matters, it's what you keep.